Well, we are days away from 2025, and the housing market is shaping up to be anything but predictable. Will home prices rise? Will they fall? Are mortgage rates finally going to drop? And if they don't, how are buyers and investors going to get creative to still make these deals happen? Well, today on the Pursuit of Progress podcast, we're going to tackle some big questions and find smart solutions for navigating the real estate world going into 2025. In today's episode, we're going to be, discussing some of the expert predictions right now in the housing market. And more importantly, what I'm really excited about is sharing some creative strategies to make financing work, even in a higher than typical mortgage rate environment at this moment. So let's go ahead and jump right in. I'm, as always, here with my co-host, Ben Adams. And my name is Adam Lang on another episode of the Pursuit of Progress podcast. What's up, Ben?
What is up? Hey, so glad to be here this week. I love talking mortgage. I love talking investing. I love talking real estate. And a lot of this is extremely relevant. There is going to be tremendous opportunity out there in 2025. Number one, you're going to have to be able to identify it. That's the most important thing. And then number two, you're going to need to know how to structure and strategize your deals. We're going to cover all of that today.
Yeah, I think this could be a multiple episode discussion, but I think we wanted to just at least put something out there since this is a very popular topic right now. And I know I'm getting a lot of questions from my audience and my just leads, customers, clients, just everybody in my sphere right now. I know I'm sure, getting the same. So before we talk about some of these creative strategies to win next year, or depending on when you guys are listening to this, when you're trying to succeed and excel here in 2025. I just want to talk a little bit more about just what we're expecting to happen next year. So in 2025, I think we're going to talk more specifically today about Denver, since that's where Ben and I are both located. But I think some of these things that we're going to talk about do apply anywhere in the country.
Yeah,
Ben,
absolutely.
let's get your feedback first on just, are you optimistic? Are you pessimistic? What are you seeing on your end with mortgage world that is leading you to think one way or the other?
Yeah, in my, now that we're at the end of 2024, I am going back and looking at my historical figures. 22 is a really, really rough year for me. 2023 was. And in 2024, my production was up 35% from 2023. So a 35% increase in 2024 compared to 2023. Personally, I am expecting and forecasting another 35% increase in 2025. So I am optimistic that we will get some rate relief in 2025. It's already started to happen a little bit with the Fed cutting rates. That's a positive sign. It hasn't turned into interest rates coming down just yet, but I do think that we will get some relief. And why that's so important is because right now the American consumer is really strapped. Affordability is an issue. And I'm not talking with like eggs or bananas. I'm talking about things that really matter, like housing. When you think about what percentage of an American's budget goes into their housing versus their eggs, well, eggs really aren't that big of a deal compared to housing. And right now, housing is 200 to 300% more expensive in America than it was just a couple of years ago. And so if we get a little rate relief, that's going to go a long way. People that have higher interest rates, they are going to be able to refinance down. And then those that are looking to purchase, those payments are going to be more affordable. On the value side, as far as, what happens with values, we'll see there. The investor inside of me, I'm not anticipating that values are going to be accelerating like they have in the past. I'm really feeling like it's going to be more of a stable, possibly slightly declining in 2025. Again, this is just personal speculation though. What are your thoughts?
Yeah, as far as the values and the appreciation, I agree. Definitely. I think it's going to be flat and maybe kind of continuing how I think it's been the last few months, which has been a little bit at a decline, in my opinion. But I'm thinking of it just more from a standpoint of, at this point, I don't think it's going to be as much about the rate dropping as it is just people hopefully going to have a mindset shift with the new presidency. Hopefully inflation improving. Just, I think the economy in general, hopefully will start to improve going into next year. And because of
Mhm.
that, I just think a lot of buyers that have been hesitant for the last year or two are finally going to make that move and at least get back onto the playing field. A lot of the predictions with the mortgage rates, right now they're at high sixes, let's just say almost 7%. The
Yeah.
predictions I've been seeing are, maybe 6% by the end of 2025. So I just don't know if that like 1% difference um, is going to be that big of a deciding factor in the big scheme of things. Or I guess to talk about it from a different angle, I just hope that that's not the one number that every single person that's a buyer or seller out there is focused on exclusively, because there are a lot of other factors and reasons to still buy and sell, even at 6, 7, 8%, whatever it may be. There's still
Yeah,
value out of there with home ownership.
I agree with that 100%. We've taught the American consumer to really focus on interest rate alone without asking the question, what does that mean for me as far as my payment and my budgeting? So there are so many home buyers that get over obsessed with their rate without actually asking themselves, what are the implications on the monthly payment? What does that look like for me? Well, someone that's looking to finance a $300,000 loan, the rate matters a lot less than someone looking to finance $1 million. So some of that depends on your market. Some of that depends on your personal situation. The winners in 2025 are going to be individuals that are homeowners and have been homeowners for the last 5 years, because they're going to have tremendous equity in their property. And if they do need to sell, they'll have that equity to roll over. It's going to be more of a challenging time for first-time home buyers or for folks that don't have that large down payment. The stuff that we're talking about right now is going to matter a lot more for them compared to someone that does have a very large down payment or can go sell their home and then buy something else and come into closing with 20 to 40% down.
Yeah, I think 2025 is going to be a year where since it is going to be a little bit tighter on everything as far as values being a little bit more flat, stuff like that. I think that's a reason even more so to be educated and to really just understand the real estate game as best as you guys possibly can. So we're even right now, if you're not in the position to buy or sell, using this opportunity right now to educate yourselves and really understand. So just one quick example of this. If you guys are very familiar with new build communities, they are becoming a bigger and bigger part of the home sales market, especially here in Colorado. I saw a stat that I think last year was like 40 or 45% of all um, home buys were new build construction homes.
Yeah.
But new builds right now are getting a lot of first time home buyers, are getting a lot of people that are tight on their budget for what they can pre-qualify for, pre-approval for their loan, excuse me. What's happening is new build communities are offering these incentives that we'll talk more in depth about here in a little bit today, but instead of a 6.8% interest rate, they're offering 4.99, and they're doing so, from a outside perspective, doing that. Why would you not take that? And for a lot of people, it's still definitely worth taking, but there's other things to think about. So without understanding and educating yourselves, you might totally pass over some of these other kind of hidden costs with a new build community. One of these would be tax rates. So the tax rate typically in a new build community could be 1%, could be as high as 1.4% over in the Commerce City Reunion area. That's in
Yep.
comparison to a resale home that might be as low as 0.4%. So that's just an example
Mhm.
that extra percent of property taxes, you're not even thinking about that because all you're focused on is the interest rate.
Yeah.
Also you just have to think about, these new build communities, are you really paying what the property is worth? Because you don't have as much room to negotiate on price. It's really just kind of, this is the price. We're offering you a discounted interest rate at so percent, but you're not coming and going, you're not, dancing with the negotiation like you would with a resale. You're
Mhm.
not having inspection objections to lower the price even further. There's a lot fewer things like that going on. So with new construction, a lot of times I think people maybe are paying over what it's really worth, or if nothing else, they're just really not finding a great.
Yeah. And why the new construction is so attractive though for so many people is because the builders get it. They understand that buyers right now are having a very difficult time. And so they're offering these incentives to help with affordability. So they're able to roll out those mandates, whereas your individual homeowner doesn't necessarily understand that or understand how all of this works. I just closed a transaction a couple of weeks ago with New Home Co. out at Painted Prairie. It's a Windrose community close to the airport, and they gave the buyer a $30,000 flex credit. And so what that means is that they said you get $30,000, you can use it however you want. If you want to take it off the sales price, great. If you want to use it to buy your interest rate down permanently, fantastic. If you want to use it to do a temporary buy down, you can do that as well. And so the buyer was working with me, and his number one thing was affordability. It does have higher property taxes, like you mentioned. So what we did is we did a 2-1 buy down. We got him an interest rate that was 2 percentage points lower in year 1, 1 percentage point lower in year 2 before the rate matured starting in year 3. But then we also paid for his HOA dues 1 year in advance, just to help with that affordability. So his HOA was paid for 1 year in advance, and then starting in year 1, he has a full 2% lower rate than what he would have otherwise. So it's identifying what is important to that individual and then structuring it and educating yourself in a way that you understand what's going on. I think when buyers here that are uneducated and they don't know how this works, if I said, I'm going to give you the option of, I'm going to give you a $15,000 credit, or I'm going to take $15,000 off the sales price. Well, most buyers who aren't educated, they're going to say, well, of course I would want the $15,000 off the sales price. Duh. Well, usually though, that's not the right way to handle it, because you can get so much more bang for your buck with a credit. You can have all of the closing costs paid for, which will allow you to come into closing with literally $15,000 less out of pocket, or you can buy the interest rate down. There's so much more that you can do than just a reduction in the sales price. So working with someone that really understands the stuff that we're talking about here.
And just for my knowledge as well, I think it's 30,000, but there's also a limit that you can have as a seller concession. Is that correct?
It is, yeah. And that depends on the loan program. So FHA, for example, the seller, whether it's a builder, traditional resale, can contribute up to 6% of the sales price, period. Conventional is different. It depends on the occupancy. So it depends if it's a primary residence, a second home, or an investment. For example, on a conventional investment purchase, the seller can only contribute 2%. On a primary residence with less than 10% down, the seller can contribute 3%. If the down payment is greater than 10%, they can contribute 6%. And if the down payment is 25% or greater, they can contribute 9%. So all of these, and then VA is the same way. VA has a specific guideline as well. So the amount the seller is allowed to contribute is based off of the individual loan program that the applicant is qualified for.
Yeah, we could go on and on about some of these other types of strategies just to really help you guys make these higher mortgage rates work for you going into this next year. You have any other ones you want to share before moving on, Ben? The last one I think was a really valuable one, just really understanding the difference with how you can use some of those dollar amount that you've negotiated, as closing costs versus just taking it off the price of the home.
Yeah, and the reason for that, and I'll just explain it briefly. Let's say that a home is $700,000, or let's say that it's priced at $715,000, and the seller says, "I'm going to give you $15,000." Well, and let's say that the homeowner, the buyer, is going to put 10% down. So $715,000 multiplied by 0.90% is $643,000. So under option 1, the buyer would be financing $643,000 at a $700,000 sales price times 90%. Under option 2, they would be financing $630,000. The interest rate's going to be the exact same under both of those scenarios. The payment, though, is going to be minimally. There's going to be hardly any difference at all in the payment, because you're talking about a $630,000 loan versus a $643,000 loan amortized over 30 years. And so you're talking about a payment difference of maybe $40 a month. So let me ask you this. Would you rather have or save $40 a month, or would you rather have an extra $15,000 in your pocket? Because if you use that as a seller credit to pay for all the closing costs, prepaids, even buy the interest rate down, you would literally have to come into closing with $15,000 less out of pocket. Now, everyone's goals are different. There's no right or wrong answer there. If you're asking me, I would rather have $15,000 in my pocket today that I can go do more with. I just would. And a lot of times that right there, that 15,000, that can be an emergency fund just right there.
Yeah. Love that, man. Talk to us a little bit too about the strategy behind the day of the month that you have your closing. So when you're buying a house, there can also be some strategy on, the day of the month. What I mean by that is you're not going to have to pay, certain dues, HOA dues, your first mortgage payment. Sometimes you can almost gain a free month depending on if you close on, for example, the 1st of the month or the 28th of the month.
Yeah. Yeah, it's interesting. And this is another thing that there's a lot of understood and misinformation out there. So number one on this, because I get this question a ton. I love educating people. Number one is the day that the loan funds, the interest starts to accrue, period. So if your loan funds on the 2nd of the month or the 31st of the month, the day that the loan funds or the day that the loan goes into effect is the day that the interest starts accruing. Now, one thing that's different in the mortgage world is that the interest is paid in arrears. So the analogy that I always use here is the rent analogy. So when you pay rent, rent is always due on the 1st of the month. So on January 1st, 2025, someone that's renting a home, their rent will be due on January 1st. And then after they pay their rent, they get to stay in the property. Mortgage interest is the opposite. You live in the property first, then you make the payment. So for example, someone that closes, let's say that, that same customer closes on let's say January 2nd. So a customer closes on a purchase January 2nd. Well, that loan is still going to start accruing interest on the 2nd of January, but the first payment, as far as the mortgage is concerned, is not going to be due until March 1st. So that's what someone means. I think that's what you were kind of getting at, to where that first payment is not going to be due until almost 60 months later. Now, the thing that's always left out on this scenario is that the interest for the month of January is collected in advance at the time of closing. So that's the part that always gets left out. And so if it's a $600,000 loan, you're going to have, several $1,000s due in interest the day that the loan funds. And that's the part that everyone always likes to leave out. But, so in that scenario, when that March payment is made, that's due March 1st, that's really for the interest of February. When you make your April mortgage payment, that's really for the interest in March. Make sense?
Mm-hmm. And just for anybody out there that maybe is not that familiar with some of the terminology that you might have heard us saying on this episode, as well as past episodes, examples of this would be a 2-1 buy down, an ARM, and ARM. There's some terms that you guys may not be that familiar with. And these are some of the things that are very important right now as we talk through some of these ideas on how to make these higher mortgage rates work. So Ben, just explain a 2-1 buy down to our audience, and just what a 2-1 is, but also just a temporary, regular buy down, just some of the most common strategies that you're using for your clients. And they're just probably going to be the most popular this current year, as the rates are probably going to stay high.
Yeah, that's another great question. And this is a strategy that I've used multiple times this year. And I think it's going to be very relevant and impactful in 2025 as well. There's really two different main types of buy downs that you can do in the mortgage world. The first type of buy down is a permanent buy down. That means that you are paying a fee called a discount point to buy the interest rate down on a permanent basis. The way that the fee and the cost is determined is by what interest rate you qualify for and then how much you want to buy the rate down. So if someone qualifies for an interest rate of 7% with no points, but they want to buy the rate down to, let's say, 6.5%, the fee is based off of the loan amount size and expressed as a percentage point. So it might cost 2 points to buy the interest rate down. Let's say the loan amount is $500,000. So in that case, it would cost $10,000 as a fee to buy the interest rate down from 7% down to 6.5%. It's important to know that that's on a permanent buy down. It's a cost and a fee, and regardless, and it's always paid at the time of closing. And if you pay the loan off early, or if you refinance the loan, or even if you sold the home, you would not get any of that money back. Once it's been paid, it is paid and it's gone, and that cost is incurred, and there's no way to get it back. A temporary buy down is a little bit different. What that means is that you're buying the interest rate down on a temporary basis. And a great way to do that is to get what we were talking about earlier, a seller credit. So you get a credit from the seller to pay for the temporary interest rate buy down. And the temporary interest rate buy down is a subsidy. It's not a actual discount fee like the permanent buy down. And that is one of the things that is so attractive. There's actually multiple things about the temporary buy downs, but that's one of them that's so attractive. So in that first example, that $10,000 is an upfront cost, and once you pay it, you don't get any of that money back. On the temporary buy down, let's say that the subsidy to buy the interest rate down is $15,000. Well, the seller would give the buyer $15,000 as a subsidy to do a 2-1 buy down. That $15,000 would be placed in the buyer's escrow account with their mortgage company on the day of closing. So at that point, the $15,000 becomes the buyer's money. So if that loan is ever refinanced or if it's ever paid off during that buy down period, and there can be a 12-month, 24-month, or 36-month buy down period. But whatever the amortized amount of that subsidy that's left, if the loan is paid off early, the buyer gets that back. So let's say after year one, the original balance was $15,000, and after year one, the subsidy balance is $7,500. Because remember, the subsidy is what pays for the buy down month after month. The note rate is actually the same, but it's bought down on a temporary basis with this subsidy from the seller. So let's say that the balance in the buy down account through the subsidy is $7,500 after year one, and the customer, they have to end up selling the property. Well, they get whatever that balance is, they get that money back. Or if they refinance, interest rates just come down on their own. They want to refinance. Instead of having a temporary interest rate, they want to have a permanent one because rates are now lower. Well, they can refinance and they would get that money back. So from my perspective, I consider that a great way to get the interest rate lower short term with a very low amount of risk, because if rates do come down, I would personally feel terrible paying $10,000 up front only for the market to come down a year later, and then now it's time to refi. Wouldn't you? That would keep me up at night, knowing that I just threw $10,000 down the drain. And so that's what's so attractive about the temporary buy downs. Short term, it can accomplish, a lower interest rate during the temporary buy down period, which translates into a lower payment, and you don't have to take any financial risk. And a lot of times, let's just use an example here. Let's just say the loan amount's $500,000. Let's say the note rate is 7%, and so the note rate's 7%. So the fully amortized payment, principal and interest, would be $3,326. So that's $500,000 at 7% amortized over 30 years. Now, if we did a 2-1 buy down, the interest rate in year one would be 5%, and the principal and interest would be $2,684. And so for the first 12 months, the principal and interest would be between $600 to $700 lower than what the fully amortized payment would be. And so that's significant, and I don't know what's going to happen in the short term, but I do believe that interest rates, medium and long term, at some point will come down. So a great way to hedge the market is to do a temporary buy down, get the seller to pay for the subsidy. The buyer's not paying for it. You get the benefit of the lower interest rate short term. You get the benefit of the lower monthly payment. And if rates do come down, you can refinance, and then whatever the prorated amount is in your buy down subsidy account, you get that money back.
Yeah, very interesting. That's very well said. I actually did not realize just that structure of how the the 15,000 is actually where that 2%, for example, is being paid out of to make up the difference from just the note that has the 7% the entire time. That's interesting.
Yeah, and so how the amount is calculated for the buy down. So, that first number that I gave, the 3,300 from the 7%, and let's just say the difference in year one is $700. So you would take 700 times 12. And then let's say that in year two, the difference between year two and the note rate was $300. Then you would take 300 times 12. And so that's how you figure out what the correct amount is that the seller would need to pay.
Well, we've got a couple other strategies to share with you guys, but before we do so, Ben, you want to let the audience know who our sponsorship is today?
Yeah, and I just want to thank our sponsors. This sponsor that we have has been so consistent, so reliable. They've supported us through thick and thin, and we would not be here without our sponsors. So, looking for a real estate team that goes beyond closing deals? At Adam Sells Denver, we're here to guide buyers, sellers, and investors with strategies tailored just for you. Visit adamsellsdenver.com for free resources or call 970-500-0252 to get started today. I feel like I get a little bit better at that every time.
That was a pretty good one. I appreciate the sponsor today. Thank you so much. So our third, this can kind of be our final topic for this episode, and it's just exploring some of these unconventional financing options for first-time buyers and investors. So I think these are two interesting groups of buyers, first-time buyers, and then also investors. A couple just things that I'll share before passing the mic over to you, Ben. The first one is just when we're talking about just getting creative. Seller financing is starting to become a little bit more prevalent again. It's something that does take a little bit more, I think, intention as far as identifying these potential sellers, for sale by owner, for example, properties. But in some cases, the seller can benefit from doing seller financing. One example of this would be if the homeowner is maybe a little bit on the older side and they just don't need all of this cash that they're going to make from selling their home, where instead they can actually benefit from just having somebody like you that's buying the property, letting them basically be the bank. So, let's just say that they're offering, instead of 7%, which is the, market rate at the moment, maybe a seller will offer, 6%. It's better for you, the buyer. You're being creative. You're finding a way to get a little bit better deal on your rate. And for the existing seller, the older person that just doesn't want to, put all their money into a 1% savings account, this is still a way for them to also generate a little bit of extra money in the process. So that's just an example of seller financing and maybe identifying some for sale by owners. If you guys happen to be a veteran, thank you for your service, but also want you to know that with VA loans, and Ben, I'd like you to touch on this, those are assumable, assuming that the person that's buying the home that has a VA loan on it is also able to qualify under the VA, qualifications. So Ben, you want to chat just about that seems to be the only assumable loan that's still being seen on a regular basis in today's market. Is that what you're saying?
That's a great point. And I just wanted to add this really quick as well. When you were talking about seller financing, there's also this myth as buyers and investors out there that I have to win the deal and it has to only favor me. And, that's not always the case. And what you were describing there is a way a lot of times to make these strategies work for the buyer and for the seller. And something like seller financing, it can be mutual beneficial. Someone that doesn't qualify for traditional financing, like you were saying, seller financing can be a great option. That can be a win for the buyer if it gets them into a home that they would otherwise not qualify for. And it may allow that seller to sell that home that they may otherwise not be able to sell. So just have an open mind to this stuff and see if you can structure your deals in a way that are mutually beneficial, because a lot of times you can. And yes, VA loans are assumable. They're not the only ones, however. FHA loans are also assumable, as are conventional ARMs. And depending on the loan amount, this is an assumable loan can be very attractive, because chances are the interest rate on an assumable loan is going to be much lower on that than what that same individual could get today, because interest rates for the last 10 years have been lower than what they are today. So, for example, if someone took out a VA loan in 2020, well, their interest rate's probably in the twos. And so a buyer could potentially assume a VA loan at 2% instead of getting one at 6 or 7% in 2024. So that's what's so attractive about loan assumption. Now, once again, this is the part that always gets left out. If the sales price is $700,000 and the loan balance is $500,000, well, there's a $200,000 gap there. And you can assume the loan, but then the buyer is responsible for, essentially filling that gap of $200,000. And so not all buyers are going to be able to do that. And so that's the second half of that gets left out. But so that's just my it can be a powerful way. Another asterisk is I just had another customer that tried to assume a seller's FHA mortgage, which again, FHA mortgages are assumable. But sometimes these servicing banks are not going to be responsive. They're not going to be cooperative. She had to apply with the servicing bank to assume the loan. This was a couple months ago. And they quoted her a 90-day turn time. Now, is that realistic on a purchase, to go through and try and assume a loan and have a 90-day turn time? And they started asking for, the same documentation multiple times, meaning that they weren't even really reviewing what she was sending in. And even though that seller had an interest rate that was in the threes, she ended up calling me back and she said, you know what? I don't want to mess with this. I don't have any confidence that they're actually going to get this done. Because me as a lender, I can't help her assume a mortgage. You have to go through the seller's mortgage company in order to assume it. So you can't work with an outside bank. And so in this case, she came back to me and she was like, you know what? Let's just do the new FHA. And so we structured that in a way where she got a new FHA loan. We did some of the things that we were talking about. We got a seller credit to allow for a buy down of the interest rate to make it a little bit more affordable for her. So this stuff can be done, and you want to educate yourself. And that's why it's so important to work with someone. If you don't understand this, work with a real estate professional or a mortgage professional that does understand this stuff.
And then one last just kind of strategy I was going to share with you guys, more related to investing, is just the house hack potential with up to from 1 to 4 units. It's still considered a regular conventional residential loan. And what I mean by that is you're getting more favorable rates, especially if it's your primary residence, for investing and multifamily investing. When you get over 4 units, it then at that point becomes a commercial loan that has typically a higher rate, and it's a different structured loan. So for investing going into this next 2025, if that's something that's high on your list of wanting to try and get into the investment world, one great way to do this is through house hacking. So let's just say, as an example, you find a 4-plex, you're able to live in 1 unit as a primary residence for yourself, and then you can rent out the other 3 units. And with that total amount that you're bringing in, ideally cover the entire rate, the entire mortgage payment that you are paying on a monthly basis. So it's a way to ideally, live for free while then also building up equity in your property, and hopefully at that same time doing some value add projects just to increase the value of the property. And I think this is one of the best ways for somebody that's willing to sacrifice a few things by, becoming a landlord and living in a a rental property with some other, tenants around you that you're kind of responsible for, if you're willing to just make some sacrifices and do that, this is one of the, I'd say, the easiest, most foolproof ways to succeed and really jumpstart your real estate investing career.
And just think about the valuable experience that you would get from the scenario that you just described, like learning how to manage tenants, learning how to qualify tenants for, the purposes of renting units out, getting the experience to house hack. All of that is, those are all different skills that you can put in your tool belt, and incredibly valuable. And when it comes to real estate investing, there are so many things online, social media, that they just glamorize the wrong things. It does, you want to have a long-term outlook. And if you have a long-term outlook, your chances of success and growing your net worth and accelerating your wealth building with the right discipline are going to be exponentially higher if you do things the right way. And so there's always a personal accountability that's involved, and make sure that your personal spending, what you're spending your money on, what you're reinvesting back into the properties, how you're managing your tenants. This is something that doesn't get talked about as much, but I work with so many investors that are just mismanaging their rental properties. They'll have a tenant in there who hasn't paid for 3 months, or the market rent for the property is $2,500. You're getting $1,000. I see this stuff all the time. It's like, you have got to manage this stuff correctly, because if you don't, what's the point? If you owned a stock and you were only getting 50% of the dividend for whatever reason, like that's terrible. Like, you own the property, you're renting it out, rent it out for market rent.
Yeah, that's a great point. And if you're not able to do that, then maybe you need to hire a property manager and adjust your criteria when you're, looking for investments, to be able to account for that additional expense, so you're not doing it yourself. If you realize before buying something that that's just not something you want to do, and that's what's preventing you from getting into real estate investing, just understand you can find deals that the numbers work, where you can be paying a property manager to handle some of those difficult scenarios that Ben's talking about.
Yeah, I have a buddy of mine, and he owns about 40 units here in Denver, and he does just that. He'll go to his properties and check up and walk around and talk to the tenants. The tenants have no idea that he's the owner. And that was his biggest piece of advice to me. I think they think he's the handyman, and like, his biggest piece of advice to me was like, don't ever let your tenants know that you are the actual owner. And that's not always practical, but it's something that I haven't forgotten. And so he uses a property manager. He has an onboarding process. They screen, they qualify all the tenants, but he'll still go, and he wants to know who's in his property, and he'll meet with them and walk the grounds. But when it comes to the hard conversations, collecting rent, he doesn't want to do that. So, he has a property manager that does that stuff.
Mm-hmm. Yeah, when I was involved with multifamily, and, one of the mentors of mine that, at the time had over 1,000 units. I remember one day I was at one of our properties, 125 unit property in Denver here, and he pulled up in this, I bet it was, worth maybe $500, just the most beat up old pickup truck. And I was like, what the heck is this? And he was like, hey man, it's just a good car to drive around to the properties. Nobody knows who you are, and, just same concept. So there's definitely some validity to that.
Yeah, it's lawsuit prevention too.
Mm-hmm. All right, guys. Well, that's a wrap for today's episode of the Pursuit of Progress podcast. The 2025 housing market might bring its challenges, but with these right strategies that we've shared with you today and a little creativity, buyers and investors can definitely still succeed. Whether it's exploring some of these rate buy downs that Ben talked about, maybe leveraging some seller concessions, or just thinking outside the box with your financing, there are plenty of ways out there to make your real estate goals a reality. So again, guys, thanks so much for tuning in. If you found any value in today's episode, please share it with somebody else who's thinking about buying, selling, or investing in 2025. And as always, you guys, just don't forget, subscribe, stay curious, stay creative, and always keep pursuing progress. Ben?
Love you guys. Until next week, keep pursuing progress. Benjamin Adams, Adam Lang out.
Because